Hello, and welcome to another Understanding Markets. We're recording this on Tuesday, the 14th of March, and I'm once again joined by our very cool-headed Chief Investment Officer, David Beaton. Hello, David.
Hello, Helen.
So, they say a week is a long time in politics. This week feels like it's been an eon in financial markets.
Yeah, an awful lot has happened, and good afternoon to everyone who's watching this. We've had a tumultuous 3 or 4 days in markets. As you say, things have turned around quite aggressively in the space of probably from the close of business last Thursday in the US. We've had the situation in the US, and I'll cover it very briefly, about Silicon Valley Bank.
Please do.
We're one of the first banks to fail for multiple years, probably since the great financial crisis back in 2007, 2008. And then we had Signature Bank in New York over the weekend also being closed down. So that put a lot of pressure on risk assets into the tail end of last week, and it carried over into global trading both yesterday in Europe and the US, overnight in Asia. But we've seen a little bit of a moderation and calming of markets today now. But kind of the escalation of the move in the regional banks since the closure of Silicon Valley Bank last Friday by the FDIC, which is the Federal Insurance Deposit Corporation in the US, it caused, I won't say a run on the other regional banks, but it certainly put significant downward pressure on US regional banks, and that fed into broader weakness and concerns about the global banking system.
And can you give us just a little bit of a primer about SVB? I'm not sure many people generally out there would have heard of this bank before Thursday or Friday last week.
You're correct there. It's a regional bank in the US, and I think it's very important to say at the outset, before I go into explaining kind of the operations that Silicon Valley Bank were operating, that is very much to a certain extent a standalone situation, and it's not the precursor, in our opinion, to a broader great financial crisis as we saw back in 2007, 2008. SVB was essentially a funding bank for startup operations in the biotech, technology, and other startup enterprises in the US. It was one of the leading lenders in that area, and essentially what happened was they originated quite a lot of loans to those areas. Those companies, having secured the funding, were starting to get cash flow. They put the cash that they were getting, the excess cash that they were getting on deposit with SVB. And for some reason, about a year ago, SVB had built up an accumulation of deposits, and they decided that they would reinvest those deposits into a range of debt securities, mortgage-backed securities, long-dated treasuries, and of course, the timing of it was disastrous, because they started to do this at the time when the Federal Reserve started on their aggressive rate hiking cycle in March last year. So it ended up that the value of the loan notes and the treasury notes and the mortgage-backed securities fell dramatically in value. They started to see some requests for withdrawal of deposits, so they were essentially forced to sell down a lot of the loans or of the debt instruments that they had on their balance sheet at a significant loss, and that caused a further drawdown in deposits. So it was essentially like the classic run in a bank.
Indeed, and you and I were both managing portfolios back in 2008 during the great financial recession.
Yep.
Are we seeing echoes of that, do you think?
No, I don't think so. Of course, it's very early days yet at this stage, but as I said at the outset, SVB was very much a unique situation. It has caused concern about and raised questions about how these regional banks are regulated, particularly SVB, and whether there's knock-on effects into other regional banks, and that's where we've seen this, the most significant weakness in the last number of days. But if you look at the Main Street bulge bracket banks in the US, in particular, like JP Morgan, Bank of America, Citigroup, these banks are all really well financed, and their capital buffers are huge. The same with European banks. In fact, European banks probably have faced sterner stress tests than the US counterparts. So while there is some concern about oversight and regulation, particularly in the US, is it being applied appropriately? I don't think at this point in time we're looking at a kind of a rerun of 2007, 2008. The fundamentals of the banks are significantly different. As I said, they're much stronger capitalized, not the same level of exposure to leverage loans, to property loans, etc. So at this point in time, it looks pretty much contained to the regional banks in the US.
And that's certainly what we're seeing in markets and in the share prices of the likes of the JP Morgans, as you mentioned,
Yep.
By comparison to the share price on those regional banks. I had a long list last week that I wanted to talk to you about, and unfortunately that's been sidelined. But I guess one of the big things we were waiting for today was that CPI print. So where did that come in?
Well, the CPI print from the US came in today pretty much in line on a headline basis. The core year-over-year reading, importantly, fell by 0.1% to 5.5%. It doesn't sound like much, but if you remember back in January, we got a surprise uplift in inflation, which kind of spooked markets. So this has raised kind of questions about what the Federal Reserve will do and what the ECB will do later this week. And when you add it into the banking situation that's developed, you were mentioning at the start, a week is a long time in politics. A week has certainly been a long time in interest rate expectations within the markets. This day last week, markets were pricing in that the Federal Reserve, who meet on tomorrow week, the 22nd, were going to increase interest rates by 50 basis points. The eruptions in the US regional banks has thrown that into doubt, and a lot of other data was there to support the Fed going aggressively, but the question amongst market participants was, can the Fed be very aggressive in hiking interest rates when essentially there is an issue within the financial system in the US? So interest rate expectations have now come down to maybe 25 basis point increase next week. Some investment houses calling for no rate increase at all and that the Fed should pause at this stage. The longer term interest rate expectations have come in from a terminal rate of 5.7% last week to about 4.5% now. So we've seen bond yields move aggressively lower, particularly at the shorter end. Biggest move since the financial, the great crash back in 1987 for German 2-year bonds, for US 2-year treasuries. So I think the Fed is in a very difficult position, and that's why this inflation number was important. Had it come in hotter than expected, then they may have felt the need to continue pushing the pedal on interest rate increases. This may give them a little bit of wiggle room to probably just go by 25 basis points and say that they're going to monitor underlying financial conditions within the market, and that inflation has shown signs of stabilization and maybe starting to kind of trend a bit lower again, which is what they're trying to achieve.
And it does mean that we've seen that yield to maturity on European bonds come down slightly as well. But you have already highlighted, certainly in our morning meetings, that Irish government bonds are still attractive at these levels.
Yeah, Irish government bonds for years had carried negative interest, negative yields on them, with ECB rates down in negative territory. ECB are continuing to move higher on interest rates. They'll probably move by 50 basis points on this coming Thursday. So Irish government bonds are now starting to look an attractive alternative to bank deposits for anyone with excess cash. You can buy a 3-year or 4-year Irish government bond with a yield to maturity of about 2.6%. These bonds are trading at a discount to the maturity value of 100. So anyone buying them, an individual or indeed a corporate buying them at the current price of 95 cents in the euro, for instance, in the 2026 bond, if they hold it to maturity, they get basically 5% uplift in capital terms, which is tax-free because there's no tax, there's no capital gains tax on Irish government bonds. So we're seeing a lot of clients who are sitting on quite a bit of money on deposit in the bank, the banks are not going to be paying any sort of meaningful deposit rate anytime soon. Both AIB and Bank of Ireland basically said that at their very strong results releases within the last week. So the alternatives for individuals and indeed corporates with excess cash amounts are limited enough. So Irish government bonds look an attractive alternative for some or portion of that money that they may have in excess.
Interesting. First time in a long time we've actually had the opportunity to make money out of Irish government bonds.
Indeed.
Thank you very much, David. That's all we have time for today. And as usual, if you have got any questions, please do get in touch with your Cantor Fitzgerald broker. We always love to hear from you. And until next time, thank you and goodbye.